Discuss how real options theory can be used alongside net present value to help companies with their investment decisions. Those students who are my previous students, they already know that in Talam company, the examiner has already tested the same requirement. Prepare a report which calculate a suitable cost of capital for D company to use a discount the F project cash flows, estimate the NPV of the F company in project ignoring the time value of the follow-on project, estimate the value of the follow-on project in dollars using the Black-Scholes. So in this question, the BSOP will also be tested. Discuss the assumptions made in the above calculations and any further factors that would need to be considered before making a final decision. Professional marks will be awarded for the demonstration of the skills, communication, analysis, and evaluation, skepticism, commercial acumen. 10 marks. So guys, very good question. Hold on. Okay. B company is a listed refrigerating manufacturing company based in M, a central European country whose currency is the M dollar. It is considering expanding by setting up a new subsidiary in the neighboring country of F where the currency is the FF. So now from the scenario, it seems that this question also relating to the international investment appraisal because in this question, the examiner is also requiring you people that your home currency is the M dollar and you are going to have a subsidiary in the Flinty land and the currency is the Flinty land florin. Now, examiner is saying D company capital structure. D company capital structure comprises 200 million shares trading at $3 each and 100 million nominal value bonds trading at 110 per 100. The examiner has given you the market value of equity and that it has an A rated according to the biggest crediting agency in the Medunk, and this corresponds to credit spread of 50 basis points. This is expected to stay unchanged as the company expands into the F. So again, this is an assumption which the examiner has used. B company has never operated in F before. So this point you can discuss in the commercial acumen that this is the new country for the company. So the company has to face political risk, some intense competition may have to face. However, one of its competitors, K company, expanded into the F a few years ago and now operates successfully in both countries. So now one of your competitors that is known as the Kunish company has already operated in that country where you are going to operate now. The directors considered that the systematic risk facing DURUNK company as it expands will be comparable to that facing of the Clonish company. Clonish company has an equity beta of 1.57 and the debt beta is 0. Again, this is an assumption. It has 10 million shares in issue and the trading at 2.4. It has also 75 million bonds in its statement of financial position, which are currently trading at 106 over 100 nominal value. The examiner again has given you the market value of debt and equity. Assume that both companies pay tax at an average rate of 30%, the risk-free rate is 3%, and the equity risk premium is 5%. Now, Ryan, please stop doing this because further will be confused maybe. Okay, please don't mind. The finance director has prepared the following forecast for the new project in F. All cash flows are forecast in nominal terms. Nominal terms mean these cash flows have already incorporated the impact of the inflation. The units to be sold have been given to you. All the data examiner provided. The revenues have been given to you. The relevant cost. This is the investment. This is the residual value. The depreciation has been given to you, including final year balancing allowance, whatever. Then this is the spot rates that have been given to you. You have to find out the future spot rates. The current spot rate has been given to you. Every country inflation has been given to you. So mean to say we will apply the purchase par parity and we will calculate the future spot rates. Examiner said the only cash flows not included in the above analysis are component costs. So the new factory business units in F will need to purchase a component from D company to incorporate within the refrigerator manufacturing process. So what is happening? The new factory which we are going to open, the new unit, that unit is requiring a component that has to be purchased by the parent company. D company has agreed to fix the price for each component at 0.50 per each unit produced and sold. The cost of the component should be treated as a tax deductible expense and F, and the contribution generated in Madang being 40% of the revenue and should be treated as a taxable income. So this we have to means to compute that there is a component that is being sold by the parent company to the newly based company that is going to operate in the F, and upon that the component price is 0.50 and the cost of the component should be treated as a tax deductible, and whatever the revenue would be contribution will be 40% of that. The tax rate in F is 10% compared to 30% in the M. Both countries tax payable in the same years and any tax losses can be relieved in the same year. The bilateral tax treaty exists between two countries. All net cash flows arising from the project will be remitted back to the DURUNK company at the end of the each year. So mean to say, in this question, there is no restriction of the block remittance. But this you can discuss the point in the skepticism that if there is a block remittance, then how we will deal that. Now, the DURUNK directors have closely monitored the new investment Kanosh company made in F a few years ago, mean the competitor, and watch how the initial investment was supplemented by the follow-on projects. They consider that if D company's initial investment project is successful, a further investment of 10 million in nominal terms after 4 years could enable the company to generate the following post-tax cash flows again forecast in the nominal terms. So guys, what is this? This is known as the real option, that now again after the 4 years, the company is going to start a follow-on project. The examiner has given you the standard deviation, that is 20 after 4 years. So that will be the time period. These are the cash flows. We'll be calculating the present value of that. And this is the PE, the expense. So now let's solve the question. The first part, discuss how real options can be used alongside the NPV. Very important, guys. You see, guys, we already know about that in the NPV. and the real options. You will tell the examiner in the NPV we have to make decision on immediately or not at all. And once it has been made, whatever we are going to start the project or not, it cannot be changed. But real options are giving you the flexibility. Like some projects can be delayed, some projects can be delayed, so that we are giving the management a chance what would be the environmental changes before a project starts. This is can be delayed. Some projects are known as to start follow-on projects, like in this question. Such as in the follow-on projects, we are seeing further expansions or to abandon the project. So guys, when we use this real option is giving us the flexibility. We can add value in our original NPV projects. This flexibility is one and only due to the real option. Otherwise, this was not available. Now, the B part of the question. Now see guys, in the B part, what is the requirement of the B part? Tell me. The requirement of the B part in this question is calculate a suitable weighted average cost of capital that D company can use to discount the F project's cash flows. Now, remember, the B part we are solving. And in the B part, we have to compute the cost of capital. See guys, how you will compute. As in this question, examiner told you there's a proxy company, that is the Cloonish company. This Cloonish company is already there in the country in which we are going to start the business unit. The examiner is giving you this Cloonish company beta. What is the equity beta of this Cloonish company, guys? Tell me. What is the equity beta?
1.57.
1.57. What is the market value of the equity of the Cloonish company? This Cloonish company is having how many shares?
100 million
shares. Per share value is
2.4.
2.4. That is 240. And the market value of the debt, how much, guys? 106 over 100 multiplied by book value of the bond, 75 million. How much? 79.5. Now see guys, as Clooney's company is already operating there in the country in which we are going to do our new setup. So we will ungear this beta. When we will ungear this beta into the beta asset, so the beta assets represent the business risk. So we are assuming that the subsidiary, the F company, which we are going to operate in that country, they will be having the same business risk as that of the Clooney's company, because Clooney's company is already operating there. Find out the beta asset. What is the formula? Beta asset is equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus T. Beta equity is 1.57. Value of equity is 240 over 240 plus 79.5. What was the tax? 30%. The Clooney's. What was the tax, guys? Tell me.
30.
What is the beta asset coming? 1.27. Now this beta assets representing the business risk. Re-gear this. But now, when you have to re-gear, guys, re-gear with the D company cost of capital. Sorry, re-gear with the DURUNK company capital structure. Because examiner is asking what is that DURUNK company should use. Guys, what is the DURUNK company value of equity? Number of shares are 200. Per share value is
$3.
3. 600. What will be the market value of the debt? 110 over 100 multiplied by 100. 110. Okay. So guys, re-gear this. This we have to find. This is 1.27. This is 600 divided by 600 plus 110 into 1 minus 0.30. What is this X coming? The equity is coming as 1.43. Now, we have computed the beta equity. Put this beta equity into the CAPM. The risk-free rate has been given to you in the question. 3%. Beta equity we have find out how much? 1.43. Active risk premium has been given to you in the question. 5%. So guys, the cost equity is coming as 1.15. Now compute the WACC. Now, in the WACC, there's again one calculation. And what is that? Cost of equity is 10.15%. Value of equity is how much? Tell me. 600?
Yes, sir.
Total 710. What about the cost of debt, guys? In this question, as the examiner has told you that the company rating is this. Why examiner has told you? Because in this, the cost of debt formula is risk free plus spread into 1 minus 3. So guys, what was the risk free? 3. What was the spread? 55 basis point. Multiply by 1 minus 0.30. What is this coming? 2.49. Apply here. Multiply by 110 over 710. What is the WAC coming, guys? Almost 9%. This was the calculation. Clear? Clear, guys? Now, what was the further requirement of the question, guys?
Sorry, sir. Could you take it back to the previous screen, please?
This is the basic calculation. Okay.
Thank you.
Now see, guys. Now we have to find out what was the problem here. Examiner told you people in this question that now we have to compute the one thing, net present value of the F project, ignoring the value of the follow-on project. So guys, now see, the question is quite understandable. We have to find the NPV of the project. All the data was given to you. All the data was given to you. Like in this question, first of all, date years 0, 1, 2, 3, and 4. We have the sales given 230. Tell me the sales. Ruqayyat,
Yes.
what are the costs?
180,
Then
199, 224, 202.
okay. Then TAD given to you.
Yes.
Tax allowable depreciation. How much? 10, 10,
10,
10.
10, 10, 10, 17. 10, 17.
Okay. Now, still one cost which was not incorporated here, that was the component cost. Anybody in the class who will try to compute the component cost? Try, guys. Tell me.
Sir, let me try.
Yes.
I think the first thing we have to do is we have to convert from, since the component cost is in dollars, is in,
Yes,
I
the
don't know, is in
component
dollars.
cost was in the dollars. First,
So
convert this dollars into the FF.
FF, yes.
Okay. So let's do it. We are having here 1, 2, 3, 4. What was the units?
Yes.
Tell me.
Okay. 10,
Units are 10,
10,
11,
11, 13,
13, and
and
12.
12. Yes.
What was the fixed price in the dollars? 0.50.
0.5. Yes.
Okay, now
So why can't we calculate the cash flow in FF, then convert into the dollars at the spot rates?
yes, we need the spot rates. In this question, examiner gave you people the inflation for every country given.
Yes.
So find out the spot rates. We are having here 0, 1, 2, 3, 4. What is the current spot?
4.25 FF over dollar.
It is 4.25 FF over dollar. Okay, predict this rate. That will be 4.25 into inflation of first currency, as the first currency is the FF. So what was the inflation?
1.05.
5%.
5%.
1.05 divided by 1.06.
1.06.
So this is coming as how much? 4.21. 4.21 multiplied by what is the inflation? 4% divided by
1.06.
this is coming as 4.13. 4.13 multiplied by
1.03.
1.03 divided by 1.06.
1.04.
4.09.
1.04 is 1.04.
Okay. And now 4.09 multiplied by
1.02.
1.02 divided by
1.04.
4.01. And remember, these all rates are in the FF over dollar.
Dollars.
Now this amount is in the dollar and the rates are in the FF over dollar. So guys, what you will do?
Multiply.
Multiply. First of all, nominate the rates. 4.21, 4.13, 4.09, and 4.01. Convert them into the FF. What are the figures in the FF? Tell me.
2.105 the first year.
2.105, 22.72, 26.59, and 24.06. Okay, this is the component cost. What was the scenario here, guys? Examiner told you, examiner tell you that The cost of this component should be treated as a tax deductible. And what is the cost? Durant company has agreed to fix the price of each component as this is the sale price by the D company and this is the purchase price by the subsidiary company who is going to have operations in the FF. We have already computed that. And if you want to compute the contribution generated, what it would be? 40% of the revenue. 40% of the revenue, guys.
So the first one is 21.05.
Okay.
The first one, first year.
21.05.
05.
So this is the component cost. We have already working for them. 21.05, 22.72, 26.59, 24. These are the component costs. These are your taxable profits. $18.95, 18.28, 4.01. These are coming as 36.06 negative. Please compute the last figure. Here tax is 10%. So it will be 1.90, 1.83, 2.44, and as examiner tells, the loss can be claimed savings 3.61. Add back TAT 10, 10, 10, 70. Investment is how much? 200 given residual value
200.
100. So these are your total cash flows. $200, 27.05, 26.45, 31.97, and 137.5. Now, all this data is in the FF. Again, apply here the exchange rate, guys. Convert into the dollars. So, I'm just typing here again the total FF. We are having 200, 5, 6.45, 21.97, 137.55. These are apply the exchange rates. Here, how much?
4.25.
4.25, 4.21, 13, 09, and 4.01. These are the exchange rates. Now convert into the dollars. And this is your remittance. How much? Multiply. Oh, sorry, divide.
Divide 47.06. The first one.
Then 6.43, I think. 6.40, 7.82, and 34.3. Now see guys, in this question, as now from here, from this point, the parent company cash flows have been started. Now look for that cash flows that are directly relating to the parent company. One cash flow is the contribution, guys. One cash flow is the contribution. Examiner told you that whatever the sale price is, upon that sale price, the contribution is how much? 40%. So guys, this is the unit. This is the price. This is the unit. This is the their price. So guys, first of all, calculate the sale price. 10 multiplied by 0.50. How much this is coming? How much?
5.
How much? First calculate the contribution.
5 times 0.5.
For your one, how? 10 are the units multiply by 0.50. This is coming as 5. Then 11 multiply by 0.50. How much?
5.5.
5.5. Then 13 multiply by 0.50. 6.5.
6.5. Yes.
Then 12 multiply by 0.50.
6.
And remember, this amount is in the dollars. The parent company, because the parent was selling. For the parent company, there was a selling price, and for the subsidiary country, that was a cost. Now, the examiner said contribution will be. This is the sales price. This is the sales price. Now calculate the contribution. Examiner told you people that the contribution will be 40% of the sale price.
Yeah.
But you see that, okay, compute the contribution. How much it is coming?
This is 2.
This is
2.2.
2.2, this,
2.6.
and this is
2.4.
take this contribution. Two, 2.2, 2.6, 2.4. 2,
2.2.
2.2, 2.6.
2.6. 2.4.
But remember, as this contribution is a direct income, so upon that contribution, pay tax. How much? Full tax.
30%.
30%. Apply the tax. 0.6. What is this? Hurry up.
0.66.
0.66. Then
0.78.
then
0.72.
still, guys, in this question, the extra tax, additional tax
Additional
is there
tax.
because our home country tax is 30% and the subsidiary tax is 10.
10%.
Now again a working would be there. This is the contribution working. Remember now, additional tax. Guys, remember this additional tax always calculated on the subsidiary
Taxable profit.
taxable profits. Now remember, we are having here 1, 2, 3, and 4.
Yes.
The subsidiary taxable profits have been given to you. We have already computed them. How much? 18.95, 18.28, 24, and 36.06. Just write them. But these are in the FF. 18.95, 18.28, 24.41, 36.04. Again, apply the exchange rates. Point 1, 2.13, 4.09, 4.01. Convert them into the dollars. .50, 4.43, 5.97, and 8.99. Now pay the additional tax. 10%. How much? 2.90.
So the additional tax is supposed to be 20%.
Oh, okay. 10 minus 5. This is 0.8. The loss saving will be there. This working will be gone into the performance. Point 9. Okay. Now you have your net cash flows. What was the discount factor which we have already computed, guys? This was 9%. These are net cash flows. apply discount factor 9%. And as you will solve this question on the Excel, if you have to gain the analysis, the professional skills, instead of writing down the discount factors, use the NPV function formula in the spreadsheet. Okay, this NPV will be calculated with the spreadsheet function. You will not compute the discount factor for every year. So the NPV of this project will be coming as a negative 1.5. As this is coming as a negative, you will say you will reject the project. But still, what has happened? We have not gone through the follow-on project. Now we have to go through the follow-on projects, and I tell you people that see, estimate the value of the follow-on project in dollars using the BSOPs. 11 marks. See now, guys, this is the follow-on product data that has been given to you. Open your BSOP calculator. This is the BSOP. Can you see, guys? Can you see, guys? Hello?
Yes.
Yes, sir.
Now see, you have to go for the BSOP model, and previously it was a very lengthy process. The students were very confused that how to apply this BSOP formula. But now the things are quite easy. Just you have to put the value of the variables, automatically the answers would be there. Now, tell me, guys, as this is a real option, call option, you have to go for a follow-on project. What is the PA? PA is the present value of cash flows. Like in this question, examiner already provided you the post-tax cash flow. The post-tax cash flows has been given to you. 7953. We have already computed the 9% discount factor. Just compute the discounted values, guys. Just compute discounted values. Like if we perform the discounted values here, tell me, we are having here five, 6, 7, and 8. We are having the cash flows. The cash flows are 7, 9,
7953.
5, 3. Tell me, Rukayat, what would be the present value? Apply the NPV function formula.
Sir, are we not all supposed to discount it one year by year?
No. Examiner will deduct your marks. Anybody in
Okay.
the class?
So will I use the 4-year period?
What?
Wow. I don't know how to.
Anybody else in the class, guys?
Yes, we are
Because
here.
I had already shared with you people the file. Do you remember? Tell me. See, guys, here we cannot apply that formula, the spreadsheet function, because that will be applied when the positive cash flows are starting from year one. Then we can apply directly that formula. Here, the cash flows are starting from which year? Year 5. So guys, what is the discount factor? What is the discount factor? 9%?
0.64.
9%. Apply. 1.09
To the power minus
raised
5.
to power minus this is coming 0.65.
6.5.
Okay. The same way.
Sir, I'm lost here. How did you find the 9% discount factor?
The 9% we already found in the A part of the question, brother. Okay. Now 1.09 raised to power minus 6.
5.596.
In this one, if you do not
0.6.
have this, means you want to save the time in the exam, you do not want to calculate, no problem, just open the formula sheet and you can write down. Okay, 1.09 raised to power minus 7, this one, and then 1.09 raised to power minus 8, this one.
0.547.
Okay, guys, this is the discount factor. Calculate the present value. This
4.55.
copy. This is present values and convert them. This is the present values, guys. Okay, and take the sum of this. So this is the initial. How much it is coming, guys?
14.16.
14.16. What is this? This 14.16 is the PA. What is this? This 14.16 is the 14.16 is the PA. What is the PE? The expense which we are going to have. How much expense we are going to have?
10.
10. So type here. The 10. What is the risk-free rate in this question? 3 time period, as this project is going to start after 4 years.
3%.
What is the standard deviation?
Yes.
20.
Oh.
So guys, can you see?
0.2. 0.2.
Now, can anybody tell me that where
So it's
made a mistake?
0.2.
Where we made a mistake, guys?
The standard deviation is 0.2. 20.
Yes, 0.20. See guys now. Guys, still the values are not correct. Anybody? Tell me where we are lacking.
The risk-free rate is 0.03.
0.0. Now, see what the values are coming. The call option value is coming as 5.55 and the put option value is coming as 0.26. If you have to apply this formula correctly, so you have to break the percentages for the risk-free rate and the standard deviation. Okay, now in this question, most of the students, they were confused, sir, which value to use, call option value or the put option value. Guys, this is not the option to abandon. This is option to delay. In the option to delay or option to expand, the only value valid is the call option value. Only option value is the call option value. That is coming as 5.55.
5.5.
Now, you have computed this value 5.55. This was the examiner asking. Okay. Now, what was the other requirement of the question? See, देखो. Now, examiner asks, we have performed this. Discuss the assumption made in the above calculations and any further factors that would need to be considered before making a final decision. Now the discussion part was very important. Now see, as this is a 50 marks question, and you know that in the 50 marks question, the report writing is very necessary to gain your professional marks. This report writing, as examiner is asking you to prepare a report for the board of directors. So guys, the communication skill which you get, that is from the report. Always you will tell the examiner the report is to the board of directors of DURUNK company. Okay, from financial manager. Then subject is very important. What is the subject? FF investment. Then there must be an introductory paragraph, or you can say introduction. Introduction is basically nothing. It is just you will copy paste what is being required in the requirements. You will tell the examiner this reports considers reports considers whether the FF investments whether FF investment should be undertaken based on the calculations performed including the assumptions made. Now, try to understand, guys. Examiner has specified that in the reports there must be headings and subheadings. Like this is the introduction headings, now the subheadings. First of all, tell the examiner what you have done. You have computed in the A part the cost of capital and investment appraisal we have performed. This is the subheading. You will tell the examiner that the cost of capital has been performed in the appendices 2 as 9% and the NPV of the project is coming as negative 1.5 million before considering the follow-on product. However, when the value of the follow-on product is there, so you know that, guys, what was happening. The follow-on project was giving you a value of 5.55 million and the NPV was previously coming as 1.5 million negative. So deduct both of this. So the value is overall coming as positive, that is 4 million. So you will tell the examiner that the appendices, the calculations performed in the appendices that shows that without the real option, the project should be rejected. But again, with the Black-Scholes option, with the real options, the project is worthwhile as it is giving us the 4 million positive NPV. So it should be undertaken, but there are still further considerations, guys. Now, what are the further considerations? What are the assumptions? Again, give heading. In this question, many assumptions were used. In this previous calculation, yes, cost of debt is going to be 0, very good. When we are telling examiner that this is being done and this should be selected or rejected, this is known as the analysis and the evaluation. You are covering in this. This whole report is covering your communication skill. Now, in the assumption, we have assumed the Clunish company as proxy. Because we are assuming that the risk that the D companies face when it is spending to the Finland, that would be same as faced by the Clunish company. This is the assumption. But again, see, now guys, remember, this is currently we are saying that we have selected the Clunish company as a proxy. Why? Because we are assuming in the question that the D company, the DURUNK company, will face same business risk as that of the Clunish company. But again, you have to apply the skepticism. You will tell the examiner there is no guarantee. There is no guarantee that this will be the case. That is skepticism. There is no, because the both may be having a slightly different risks. In the question, it has been stated that the gearing will remain constant because whatever the capital structure was previously, when we were re-gearing, when we are going to do the new investment, we are using the same capital structure. So, but what as this is an assumption, you challenge this assumption. How? You will tell the examiner that as we are going to start a new project, so maybe we have to do some loan, we have to do some borrowings. If the borrowings are there, so what will happen? The gearing will change. In the question, it has been assumed that the credit rating will remain same. Credit rating will same. Challenge it. Currently, it is 55 basis. But what happened? As the company is going to do the new project, if the company is going for the new financing and the gearing are increased, so maybe the ratings are down by the crediting agencies. If the ratings are down, so what will happen? The investors' confidence will be lost. Again, this is skepticism. Then NPV calculations. See guys, in the NPV calculations, we have been given the already calculated data like the sales have been given to you, the costs have been given to you, the investments have been given to you, the residual values have been given to you. Mean no spotting workings are there. Mean telling the missing information that from where these figures are coming. And we have been given the data only for the 4 years. After the 4 years, what will happen? Whether the project will be abundant or whether the project will be sold out. What we have not been given such information. And in this calculation, examiner has a fixed price. You know that fixed price was 0.50. This was the 0.50. This fixed price. As this price is being charged by the D company to the newly business unit. So whether this is acceptable, it is a transfer price, and the transfer price rule is the transfer price should be arm length price. Challenge this assumption that upon which basis the companies are using this price, whether this is an arm length price or not. In this question, the tax rates have been used as 30 and the 10. If the tax rates will change, then what will happen? The inflation rates have been constant. If the inflation rates will change, what will happen, guys? The purchasing power parity, the future spot rates will change, and ultimately the balances which you are having in the NPV calculations, that all balances will change. Now discuss the BSOP. In the BSOP, already know Black-Scholes option pricing model. It is being used for the European call options. Mean those options that can only be exercised when the option expires this real option, remember guys, real options are more likely to be American call options. If this is like the American call option, which can be exercised anytime before maturity. So guys, what is happening? We are basically applying this VSOP real option while having an assumption that this is the European call option. But in fact, this is the like an American call option. So the values may be incorrect. Challenge this. Apply the skepticism. Now, in the real option, we have used the risk-free rate. We have used the volatility. We are saying that the risk-free and the volatility will remain same. This is the assumption. And they are accurate, constant. These, if these means the assumptions did not hold true, what will happen? So the estimates are not accurate. So guys, these are the skepticism. Now examiner asks you people to discuss the other factors as well. That is known as the commercial acumen. Mean to do so, is the commercially viable for us or not? See guys, the Fortland has a different currency. And this DURUNK company is having the M dollar. So guys, what is happening? These both means say the countries. First, they are having the currency difference due to which they have to bear the transaction cost. Number two, there may be a language barrier, the time zone barrier. And as in the question, it has been stated that the MS, the means say the DURUNK company is going for the first time. As it's going for the first time, what is happening, guys? DURUNK company may face any cultural issues. This is commercial acumen. Any political risk. Competition. Now, you know that currently in the FF, the tax is 10%. If you are having there for the 4 years and during your presence, a new government is coming and that government is imposing more tax, like the tax is now 40%. Then what will happen? Mean whatever the company is earning there in the FF, that profit 40% will be already taxed. So the leftover will be very low. That you have to keep in mind that when you are operating there, if the governments are changing, then what will happen? The further issues, there may be any ethical or environmental issues can be here. Ethical or environmental issues can be there. Or as the company is going for the first time, so the company has to go for the average wage rates. the company is complying or not. Otherwise, then the company may be penalized. And in this question, we have only go for the real option, which was a follow-on product. The company, before relying on the figures, should go for the other, like the company should uh, think for the option to delay or the option to abandon as well. So in the last, you will write the conclusion. And on the basis, you will tell the examiner the strategic NPV of the project is positive, so the project is financially viable. However, before making a final decision, there are lots of factors that should be considered, such as ethical environmental issues, and then the care should be taken. That was all about your report writing, commercial acumen, skepticism, and